Welcome to Chapter 13, Equity Valuation. Valuation is where finance takes an uncertain future, makes the assumptions explicit, and then, with admirable confidence, formats the answer to two decimal places. The decimal places are not the problem. Forgetting the assumptions is the problem. A stock's market price is observable. Intrinsic value is estimated. Market price tells us what investors are willing to pay today. Intrinsic value is an argument about what the future cash flows are worth after accounting for time, risk, growth, and reinvestment. That distinction explains why a great company can still be a disappointing investment. The business can execute well while the stock falls because the starting price assumed even better results. The reverse is also possible. A mediocre company can produce a strong stock return when expectations were already terrible and the outcome is merely less bad. History gives us plenty of examples. During the Nifty 50 era, investors treated a group of admired growth companies as if price barely mattered. During the dot-com boom, distant possibilities were sometimes valued more generously than current cash flow. During the 2022 rate reset, many high multiple growth stocks declined sharply because distant cash flows were discounted at higher rates. In each case, the business story mattered, but the price paid for the story mattered too. This chapter develops several ways to organize that argument. We will distinguish book value, market value, and intrinsic value. We will use dividend discount models, including constant growth and multi-stage versions. We will interpret price to earnings ratios, PEG ratios, and the present value of growth opportunities. We will also connect valuation to free cash flow, which is especially useful when dividends do not reflect the firm's full capacity to return capital. The goal is not to find one magic formula. The goal is to build a disciplined process that asks what cash flow can reach owners, how fast it can grow, how risky it is, what the market already expects, and what evidence would change the conclusion. A spreadsheet can calculate value. It cannot decide whether the story deserves to be believed. That is our job. By the end of this module, students should be able to do four things. First, distinguish intrinsic value from market price and book value. Book value comes from accounting records. Market price comes from trading. Intrinsic value comes from a forward-looking estimate of cash flows and risk. These numbers may be related, but they are not interchangeable. Second, apply dividend discount logic. That includes the constant growth model for mature firms and multi-stage models for companies whose current growth rate cannot reasonably continue forever. Students should be able to explain the logic before reaching for the formula. Third, interpret valuation multiples, such as price to earnings, PEG, and the present value of growth opportunities. A multiple is not just a label like cheap or expensive. It compresses assumptions about growth, risk, payout, accounting quality, and capital intensity into one number. Fourth, explain free cash flow valuation and common valuation pitfalls. Free cash flow helps when dividend policy is not a clean measure of the cash the business can ultimately distribute. It also forces us to confront reinvestment, working capital, capital spending, debt, and dilution. These objectives connect. A valuation model produces an estimate. A multiple provides a cross-check. Financial statements provide the evidence. Market price provides the hurdle. The analyst then decides whether the gap between price and estimated value is large enough to compensate for uncertainty. The assessment focus is application, interpretation, and judgment. A strong answer does not merely say that higher growth raises value. It asks whether the growth is sustainable, what reinvestment is required, whether returns on that reinvestment exceed the required return, and how sensitive the estimate is to small changes in assumptions. Valuation is not a vocabulary contest. It is a structured disagreement with the market. Before making that disagreement public, it is useful to have more than a colorful chart and a strong feeling. The module is organized around four connected questions. Question 1 is value concepts. We begin with book value, liquidation value, replacement cost, Tobin's Q, intrinsic value, and market price. Each measure answers a different question. Book value describes the accounting investment recorded on the balance sheet. Liquidation value asks what might remain if assets were sold and obligations paid. Replacement cost asks what it would cost to rebuild the productive assets. Tobin's Q compares market value with replacement cost. Intrinsic value estimates the present value of expected future cash flows. Question 2 is dividend models. The dividend discount model says that an equity share is worth the present value of the cash distributions its owner expects to receive. The logic is durable, but implementation becomes difficult when payouts are irregular, buybacks are important, or the company is in a high growth stage. Question 3 is multiples. Price to earnings and related ratios provide fast comparisons, but fast does not mean automatic. A multiple is meaningful only when the firms have reasonably comparable growth, risk, accounting, cyclicality, and capital needs. Question 4 is free cash flow. Free cash flow models value the operating cash that remains after the investment needed to sustain and grow the business. Depending on the version, we can value cash available to all capital providers or cash available specifically to equity holders. These methods should not live in separate boxes. A good valuation uses them as cross-checks. A dividend model might suggest one range, a free cash flow model another, and peer multiples a third. The differences are useful because they reveal which assumptions are doing the work. The sequence also matters. We start with the business, not the formula. We then forecast cash flow, select a discount rate, then estimate continuing value, compare the result with market evidence, and stress the assumptions. The goal is a usable mental model, not a vocabulary list. Or, put differently, we want a process that still works after the exam when the company stops cooperating with the example. This slide brings the chapter's central concepts into one view. Intrinsic value is the present value of expected future cash flows discounted at a required return. It is an estimate, not a fact. Two careful analysts can use the same financial statements and reach different values because they disagree about growth, margins, reinvestment, risk, or the terminal period. The market capitalization rate is the required return for equity cash flows. It reflects the time value of money and compensation for risk. A higher required return lowers present value because future dollars are discounted more heavily. The dividend discount model values equity as the present value of expected future dividends. The model is theoretically clean because dividends are cash actually paid to shareholders. It becomes less convenient when firms return capital primarily through share repurchases or retain cash for long periods. PVGO means the present value of growth opportunities. One useful decomposition is that stock value equals the value of the existing earnings stream with no growth, plus the value created by future investment opportunities. Growth creates value only when the return on new investment exceeds the required return. If a company reinvests at poor returns, more growth can destroy value. That point deserves emphasis. Growth is not automatically good. Scaling a profitable engine can create value. Scaling a leak simply creates a larger leak. The price to earnings ratio is price per share divided by earnings per share. It is popular because it is easy to calculate and communicate. But the ratio depends on the quality and durability of earnings, growth, risk, payout, capital intensity, and where the company sits in its cycle. Free cash flow is the cash remaining after operating needs and reinvestment. Free cash flow to the firm is available to debt and equity capital providers and is generally discounted at a weighted average cost of capital. Free cash flow to equity is available to common shareholders after debt financing effects, and is discounted at the cost of equity. The slide's final point is the grading standard. Naming the concept is not enough. A strong answer explains how it changes the decision. Higher risk changes the discount rate. Higher reinvestment changes free cash flow. A higher PE ratio changes the burden of proof. A large PVGO means more of today's price, depends on future opportunities that have not yet produced current earnings. Definitions are the map. Legend. Valuation begins when we start driving. A disciplined equity valuation can be organized into 6 stages. Step 1 is the business model. Before forecasting anything, understand how the company makes money. Identify the revenue drivers, customer economics, competitive advantage, pricing power, cost structure, capital intensity, and balance sheet constraints. A valuation model cannot rescue a business model the analyst never understood. Step 2 is the forecast. Estimate revenue, margins, taxes, working capital, capital spending, earnings, dividends, or free cash flow. The forecast should connect to operating drivers. Saying revenue grows 12% because cell D47 says 12% is not analysis. Explain what produces the growth. Step 3 is risk. Choose a discount rate consistent with the uncertainty in capital structure. The rate should reflect the risk of the cash flow being discounted. Equity cash flow requires an equity return. Firm cash flow requires a blended capital cost. Using the wrong rate can create a beautifully formatted error. Step 4 is terminal value. Most companies are expected to operate beyond an explicit 5 or 10-year forecast, so the analyst must estimate continuing value. That may use a stable growth perpetuity or an exit multiple. Terminal value is often a large part of total estimated value, which makes its assumptions especially important. Terminal value is where spreadsheets like to hide the future. The analyst should not let them. Step 5 is comparison. Check the result against market price, peer multiples, historical ranges, transaction evidence, and alternative valuation methods. A cross-check does not prove the estimate, but it can reveal unreasonable assumptions. Step 6 is challenge. Stress the key variables and ask what the market already expects. Build a base case, downside case, and upside case. Identify the assumption that matters most. Ask what evidence would invalidate the thesis. The 2022 growth stock repricing is a useful example of why the process matters. Many businesses were still growing, but the discount rate rose and investors became less willing to pay extreme multiples for cash flows far in the future. The company did not necessarily become bad. The valuation equation changed. A strong process separates business quality from investment attractiveness. It also separates a bad outcome from a bad decision. An investment can lose money even when the original reasoning was sound because uncertain outcomes remain uncertain. The analyst's responsibility is to make the assumptions visible, size the position appropriately, and update the work when the evidence changes. Process discipline turns chapter vocabulary into a repeatable workflow. It also makes the postmortem more useful than saying in hindsight that the market was irrational. The key relationship on this slide is the constant growth dividend discount model. Price equals next year's expected dividend divided by the required return minus the expected perpetual growth rate. There are 4 important pieces. First, the numerator uses the next dividend, not the dividend that was just paid. If a company just paid $2 and dividends are expected to grow 4%, next year's dividend is $2.08. Second, a higher expected dividend increases value, all else equal. This is the direct cash flow effect. Third, a higher required return lowers value. The required return sits in the denominator because riskier or more distant cash flows are worth less today. Fourth, higher sustainable growth raises value, but only when the growth rate is realistic and below the required return. The model assumes the company can grow forever at a stable rate. That makes it most appropriate for mature firms whose growth, payout, and risk have reached a sustainable condition. The difference between required return and growth is crucial. Suppose next year's dividend is $2.08. The required return is 9% and growth is 4%. The denominator is 5 percentage points, so estimated value is $41.60. Now change the growth rate from 4% to 5%, holding the required return at 9%. Next year's dividend becomes $2.10, while the denominator falls to 4 percentage points. The estimate rises to $52.50. Change the required return instead. Keep next year's dividend at $2.08 and growth at 4%, but raise the required return to 10%. The denominator becomes 6 percentage points, and estimated value falls to about $34.67. Small changes in assumptions can create large changes in value. That is not a defect in the formula. It is a warning about the economics. When required return and growth are close, much of the value depends on a narrow spread that is difficult to estimate precisely. The model fails mathematically and economically when perpetual growth equals or exceeds the required return. No company can grow faster than the economy forever without eventually becoming the economy, which would create a few antitrust questions. The correct habit is to explain the units, direction, and assumptions before calculating. Higher dividends help, higher risk hurts, higher sustainable growth helps. Unsustainable growth makes the model look precise while quietly removing its meaning. This slide compares dividend discount analysis with price to earnings analysis. The dividend discount model is a direct present value framework. It works especially well for mature companies with stable dividend policies. It forces the analyst to specify the payout, growth rate, and required return. It can also be extended into a multi-stage model when the company grows rapidly for several years and then settles into a stable phase. Its weakness is practical fit. A profitable company may pay no dividend because it reinvests, repurchases shares, or accumulates cash. In that case, the model may understate the economic capacity to return capital unless the analyst uses a total payout or free cash flow approach. Price to earnings analysis is faster. Divide price by earnings per share and compare the result with peers, history, or a justified multiple. The ratio is useful because earnings are widely reported and understood, but PE is a compression algorithm with no warning label. It combines assumptions about growth, risk, payout, accounting quality, and capital intensity into one number. A high PE ratio does not automatically mean overvalued. It may reflect high expected growth, durable margins, strong returns on capital, low financial risk, or unusually valuable growth opportunities. A low PE ratio does not automatically mean cheap. It may reflect declining earnings, cyclicality, leverage, poor governance, or a business model the market expects to deteriorate. Cyclical companies create a classic trap. Near the top of the cycle, earnings can be unusually high, and the PE ratio can look low. Near the bottom, earnings can collapse, and the PE ratio can look high or become meaningless. The apparently cheap multiple may arrive just before profits normalize downward. The PEG ratio divides the PE multiple by an expected growth rate. It can be a useful screening tool, but it does not fully adjust for risk, growth duration, capital intensity, or the quality of the forecast. A company growing 20% for 1 year is not economically equivalent to a company growing 20% for 10 years. The present value of growth opportunities adds another perspective. Start with the value of existing earnings, as if the firm had no valuable growth projects. Then add the value created by future reinvestment. Growth deserves a premium only when the company can invest at returns above its required return. The best method depends on the job. Use dividend models when payouts are representative. Use free cash flow when reinvestment and payout policy matter. Use multiples as comparisons and cross-checks. When possible, use more than one method and study why they disagree. The portfolio does not care which method won the classroom debate. It cares whether the assumptions were economically coherent. This slide connects valuation discipline to the modern market. High growth and high multiple stocks make valuation more important, not less. The stronger the narrative, the easier it becomes to confuse an excellent business with an attractive stock at any price. Start with the question: what changed? Interest rates can change. A lower discount rate raises the present value of distant cash flows, which tends to support long-duration growth stocks. A higher discount rate does the opposite. During the low-rate period leading into 2021, investors were often willing to pay large multiples for growth expected many years in the future. During the 2022 rate reset, those distant cash flows were discounted more heavily and many multiples compressed. Growth expectations can change. Some pandemic-era beneficiaries experienced extraordinary demand that investors treated as a new permanent trend. When demand normalized, the businesses did not necessarily disappear, but the market revised the duration and magnitude of growth. Competition can change. A company may create a profitable market and then attract rivals, regulation, customer bargaining power, or technological substitution. The forecast must account for who captures the economics, not merely whether the industry grows. Now ask, what stayed the same? The present value logic stayed the same. Price still depends on expected cash flows and the return required to bear risk. Growth still creates value only when it earns an adequate return on capital. Expectations still matter. A good result can disappoint when the market expected a spectacular result. Who benefits? Companies with durable competitive advantages, pricing power, high incremental returns on capital, disciplined reinvestment, and balance sheet flexibility deserve serious consideration. But the valuation must still leave room for error. A wonderful company priced for perfection may offer a narrow margin of safety. What risk remains? Forecast error remains. Competitive risk remains. Regulatory risk remains. Dilution remains. The discount rate can move. Terminal value can dominate the model. Management can allocate capital poorly. The market can be right about the opportunity and wrong about which company captures it. The Nifty 50 and the dot-com era offer the same lesson in different clothing. Investors identified many real long-term trends and several excellent companies. The mistake was sometimes paying a price that required near-perfect execution for too long. One practical technique is the reverse discounted cash flow analysis. Instead of asking what the company is worth under our assumptions, ask what revenue growth, margin, reinvestment, or return on capital the current stock price already implies. Then decide whether those expectations are plausible. A high multiple is not a crime, it is a demand for evidence. A low multiple is not automatically a gift. Sometimes it is the market leaving a note on the windshield. Modern valuation should be humble, scenario-based, and explicit about what the price already assumes. The story can be exciting. The arithmetic still gets a vote. Let us work the practice case carefully. The company just paid a dividend of $2. Dividends are expected to grow at 4% forever. The required return is 9%. The stock trades at $48. Task 1 is to compute next year's dividend. Take the $2 dividend that was just paid and multiply it by 1.04. That gives an expected next dividend of $2.08. Task 2 is to estimate intrinsic value using the constant growth dividend discount model. Price equals next year's dividend divided by the required return minus the growth rate. The numerator is $2.08. The denominator is 9% minus 4% or 5 percentage points. $2.08 divided by 0.05 equals $41.60. Task 3 is to compare intrinsic value with market price. The model estimate is $41.60. The market price is $48. The stock trades $6.40 above the estimate. Measured relative to the market price, a decline from $48 to $41.60 would be about 13.3%. Measured relative to the intrinsic value estimate, the market price is about 15.4% higher. Both percentages describe the same dollar gap from different starting points, so be clear about the denominator. A mechanical conclusion would be that the stock appears overvalued under these assumptions. A better conclusion is that the stock appears overvalued under this specific model and these specific assumptions. That wording preserves the uncertainty. Task 4 is to name an assumption that deserves stress testing. Several answers are strong. The growth rate may not remain at 4% forever. The required return may be higher or lower. Dividend policy may change. Buybacks may be more important than dividends. The business may not be mature enough for constant growth. The company's return on reinvested capital may weaken. Inflation and competitive conditions may change the long-run economics. Sensitivity analysis shows why this matters. If growth rises to 5% and the required return stays at 9%, next year's dividend is $2.10, and an estimated value becomes $52.50. The stock would appear undervalued at $48. If the required return rises to 10% while growth remains 4%, estimated value falls to about $34.67. 1 percentage point changed the conclusion. That is not a reason to ignore the model. It is a reason to focus on the assumptions. A strong recommendation might say, based on a 4% perpetual growth rate and a 9% required return, estimated value is $41.60, below the $48 market price. I would not purchase the stock without evidence that growth is higher, risk is lower, or total shareholder payout is greater than the dividend assumption suggests. Do not automatically turn the result into a short sale recommendation. A valuation gap can persist, the assumptions can be wrong, and the market may be pricing information the analyst missed. Valuation is a decision input, not a court order. Grade for reasoning. The student should calculate the next dividend correctly, apply the formula correctly, compare price and value, identify a meaningful assumption, and explain the remaining risk. The formula is the easy part. The judgment begins after the equal sign. This slide identifies 5 common valuation mistakes. Mistake 1 is using book value as intrinsic value without analysis. Book value is based on historical accounting and may omit valuable intangible assets or overstate assets whose economic value has deteriorated. It can be informative for banks, insurers, asset-heavy firms, and liquidation analysis, but it is not automatically what the equity is worth. The balance sheet has never met a brand, network effect, or organizational culture it could measure perfectly. Mistake 2 is applying constant growth to an unsustainable growth company. A firm cannot grow faster than the economy forever. High growth businesses require a multi-stage model that eventually transitions toward a mature growth rate and realistic return on capital. Mistake 3 is comparing PE ratios across firms with different risk and growth. 2 companies can share an industry label while differing in leverage, margins, cyclicality, accounting, reinvestment, and competitive advantage. A multiple comparison is only as good as the comparability. Mistake 4 is ignoring earnings management. Accounting earnings can be affected by estimates, accruals, capitalization policy, restructuring charges, stock compensation, and one-time items. Analysts should reconcile earnings with cash flow and study whether adjustments improve understanding or simply improve the story. Mistake 5 is treating terminal value as a plug. The terminal period should represent a mature economic state. Growth, margins, reinvestment, and return on capital must be mutually consistent. An exit multiple should also be justified by the company's expected characteristics at that future date, not borrowed from whichever peer group makes the target price work. Several additional mistakes deserve attention. Do not confuse precision with accuracy. A model can produce $47.83 without being accurate to the nearest cent. Use ranges and scenarios. Do not double count growth. If higher growth requires more capital spending and working capital, the cash flow forecast must include the reinvestment. Revenue growth that consumes cash is not free. Do not ignore dilution. Stock-based compensation and future share issuance affect value per share. Buybacks can offset dilution, but only if the company actually retires shares at sensible prices. Do not use a low PE ratio without checking normalized earnings. At a cyclical peak, earnings may be temporarily high. At a trough, the ratio may look high because earnings are depressed. Cheap can be a bargain or a diagnosis. Do not assume a great total addressable market guarantees great shareholder returns. Competitors, customers, employees, and suppliers may capture much of the value. Do not make the discount rate absorb every uncertainty. Model operating risks in the cash flows where possible and use the discount rate consistently. Otherwise, the same risk can be counted twice. And do not forget what the market price implies. A valuation thesis should state which assumption differs from consensus and why the gap is likely to close. The easiest errors usually come from skipping fit, risk, cost, or assumptions. The model is not a truth machine. It is a disciplined way to expose the argument so someone else can challenge it. Here is the knowledge check. In the constant growth dividend discount model, value increases when A, expected dividend growth rises, holding the required return and dividend constant. B, the required return rises, holding other inputs constant. C, expected dividends fall. Or D, growth exceeds the required return forever. Pause for a moment and choose your answer. The correct answer is A, holding the next dividend and required return constant. A higher sustainable growth rate reduces the denominator in the constant growth model and increases estimated value. Answer B is incorrect because a higher required return discounts future cash flows more heavily and lowers value. Answer C is incorrect because lower expected dividends reduce the cash flow available to shareholders. Answer D is incorrect because the model requires the perpetual growth rate to remain below the required return. If growth equals or exceeds the required return forever, the formula stops producing an economically meaningful finite value. One nuance matters. Higher growth increases value only when the assumption is sustainable and when the company can support that growth through economically attractive reinvestment. Growth created by investing at returns below the required return can destroy value even though sales and earnings become larger. The correct answer is A. The formula is simple. The quality of the growth assumption is where the real work begins. Let us close Chapter 13 with 3 takeaways. First, intrinsic value is a present value estimate, not a fact. It depends on expected cash flows, risk, growth, reinvestment, and a continuing value assumption. A responsible analyst should present a range and identify the variables that matter most. Second, growth creates value only when the return on reinvestment justifies it. Higher sales, assets, or earnings do not automatically create shareholder wealth. The company must earn returns above the opportunity cost of capital and eventually convert growth into cash that can reach owners. Third, multiples are useful only when economic comparability is real. Price to earnings, PEG, price to book, and enterprise value ratios can summarize information quickly, but they do not eliminate the need to understand accounting, cyclicality, leverage, margins, and growth duration. After the slides, the homework is the dividend and multiple valuation case. The discussion asks whether a high PE stock is always overpriced. The quiz contains 10 automatically graded questions covering intrinsic value, dividend models, growth, PVGO, valuation multiples, free cash flow, and common mistakes. Finish the module with the question on the slide. What would change my recommendation? Would the long run growth rate change? Would the required return change? Would margins or reinvestment needs differ from the forecast? Would the company shift from dividends to repurchases? Would competitive pressure reduce returns on capital? Would a new product extend the growth runway? Would dilution increase? Would the current price already reflect the upside case? That question keeps the valuation alive. A model should be updated when evidence changes, not defended like a family heirloom. The next chapter moves into financial statement analysis. That is the natural next step. Equity valuation requires credible inputs, and those inputs come from the income statement, balance sheet, cash flow statement, footnotes, and ratio analysis. Chapter 14 will help us evaluate profitability, leverage, asset efficiency, earnings quality, and the economic drivers behind the forecast. For now, remember the central lesson. The company can be excellent. The industry can be attractive. The story can be compelling. None of those facts removes the need to ask what price already assumes. Valuation does not tell us the future. It tells us what must be true for today's price to make sense. And when the required assumptions look heroic, it is worth remembering that the market does not award extra credit for enthusiasm.